Hey, what's up, my friend? So I remember right in my early years of trading, one of the first few indicators I came across was the moving average indicator. I learned that, when the fast moving average crosses above the slow moving average, you buy. And when the fast moving average crosses below the slow moving average, you sell. So I tried this strategy and guess what, right? I was actually losing consistently. So at that point in time, I kind of, blame the indicator. Oh, moving average, it's a scam. It's a lagging indicator. It doesn't work. And then I move on to, the next step in my trading career. So fast forward a few years later when I was working in the prop trading firm, I realized that my boss is actually using a moving average indicator. So I got intrigued, right? And I asked myself, how do I, effectively use this indicator when I've, failed at it before? So I went into testing and research mode and I realized a few secrets that I wasn't aware of before. So this is why in today's trading, I want to share with you, some of my findings. Specifically, you will learn, right, the truth about moving average indicator that nobody tells you. One simple technique to help you avoid false breakout, right? And I believe, right, 90% of traders don't know this at all. How to predict market turning points ahead of time so you can better time your entry with low risk. And finally, I'll share with you how to ride massive trends without getting stopped out on a minor pullback. Sounds good? Then smash the thumbs up button. If not, then hit subscribe. Let's get started. Okay, so what is the moving average indicator all about? So let me explain. This is an indicator that calculates the average price over a given period. So for example, if you have a 20-day moving average, it simply calculates the average price over the last 20 days. If you have a 200-day moving average, it simply calculates the average price over the last 200 days. So generally, you can look at moving average as an indicator that follows the price, but with a lag, right? It follows the price, but it always lags the price. So let me give you an example. So if you look at this chart over here, you can see that this is the pound against the Japanese yen. And let me overlay the 20 period moving average. So you can see over here, the 20 period moving average is this red line over here. So you can see that as the price goes up, the 20 period moving average also goes up together with the price, right? Following the price movement. And over here, as the price goes down, notice how your moving average is pointing down lower as well. Okay, so one thing to note about moving average is that if you use different settings of moving average, you will get different responsiveness of it. So for example, if I go with a 50 period moving average, this means that it calculates the average price over the last 50 days. You realize that this moving average is not quite as responsive as the 20 period moving average, which is this red line over here. Then this blue one is the 50 period moving average. You can see that the blue one is not quite as responsive because this is a longer term moving average, right, relative to the 20 period moving average. And if you overlay with another longer term moving average or an even longer term like the 200 period moving average, you can see that it's even less responsive. So hopefully this gives you a good idea to understand what the moving average indicator is all about, because in the next section, right, we are going to use this indicator, right, and learn how to avoid false breakout. Now, let me share with you a mistake, right, that almost all new traders make that cause them to get caught, right, in a false breakout. So let me just show you this, right? So let's say the price is in a range between these highs and then these lows, or otherwise, in between support resistance. Then the price goes up, comes down, goes up, comes down, and then it breaks out. And then traders will think, oh man, Rainer, look how bullish this is. It's time to buy. And then they buy. But what's the problem with this? Well, the problem is that the price, right, it has moved too fast, too soon, right? It has just expanded its energy, right, moving from this lows of support, right, all the way up into this highs of resistance. And when it has expanded its energy, right, traders who entered near the lows of support, they will be looking to take profit at resistance. So that means that they will exit their position, they will sell, and that puts selling pressure in the market. When the price is at resistance, traders who see this, right, who are on the sidelines and see this, right, they'll think, price is at resistance, let me short. Again, more selling pressure in the market. So when there's enough selling pressure in the market, usually what happens is that the market starts to falter and goes back down lower, and you get caught in a false breakout. So what's the solution? Well, the solution is relatively simple, really. So let me explain what you should do instead. So let's say again now market is in a range between these highs and these lows. And now market again goes up, comes down, goes up, comes down, goes up. This time around, right, we are looking for a build up, otherwise known as a consolidation at resistance. Now, why is that, right? Very simple. Because again, the market has expanded its energy earlier, And you want it now to store potential energy for the next move up higher. So when it goes into this tight consolidation over here, right, it's storing potential energy, right, for the market to make the next move up higher. At the same time, it's also telling you, right, that it's there are buyers stepping in. So if you imagine, right, previously price is at the lows of support, people bought it, traders bought it, and then they are looking to sell at resistance. And they sell at resistance, but somehow, even though they've taken profits and they sell at resistance, the price is still not dropping. Why is that? Well, it could mean, right, there is another group of traders coming in, right, willing to support this price at resistance. They're willing to buy in front of resistance because they expect the price to move up higher. Make sense? So at this point, you might be wondering, okay, so where does the moving average, come into play? And it's very simple, really. When you notice the price forms a build-up at resistance, you can overlay with, let's say, a 20-period moving average. Okay, I'll put this in green. And you want to see the 20-period moving average, right, starting to slope, right, and support, right, near the low of the build-up. The 20-period moving average coming to the low of the build-up to ready to support the price. So this tells you that, if the price does break out of resistance, let's say the price does break out of, let's say, the highs of this resistance over here, there's a good chance that the market could now follow through higher. So let me share with you a few examples. Okay, so now this is the chart of dollar against the Chinese yuan, and you can see this market is in a range between these highs and this low over here. So the first thing we have is, number one, price is in a range. Second thing we are looking for is for a build-up to form, right, near the highs of the range, near the highs of resistance, and we have this build-up form over here. So we have it, right, a build-up, let's call it just BU, build-up. And the third thing we are looking for is for the 20-period moving average to reach the low of the build-up, to kind of support the price higher into resistance. So basically, we want a 20-period moving average, right, to touch the low of the build-up. So let's overlay with the 20 MA, as you can see over here. And you can see, right, that the 20-period moving average has touched, right, the low of the build-up, and it's kind of like supporting the price up higher into resistance. So when you see this, right, what you can do is you can look to go along, right, as the price breaks above resistance. So one option is to, let's say, place a buy stop order above the highs of this resistance, let's say above this highs. Okay, so let's see what happened. So in this case, you can see that the price over here on this candle, it probably would have triggered your entry as the price, this candle here, spike up through this highs and, got you into a long trade. Your stop loss, right, can just be distance below the low of the build up, somewhere around here. Okay, and in this case, it's a cherry pick chart, and you can see that the market went in our favor. Then it starts to make a pullback, retest a previous resistance, which could become support, and then pretty much, explode up higher. So again, this is a cherry pick chart. I just want to, be honest with you. So let's have a look at another example. So this is the chart of Bitcoin daily time frame. And again, first thing first, number one, we have the price in a range between this high and this low. So number one, price is in a range. Second thing, we are looking for the price to approach near the highs of the range, resistance. So we want the price to approach near the highs of the range, as you can see over here. Price forming a series of higher lows into resistance. Let's call it HL into resistance. So this is another variation of a build up, right? As you can see over here. And the third thing we are looking for is for the 20-period moving average to support, right, the low of the build up, or to support this higher low into resistance. We want the 20 MA to basically catch up with the price. So if I overlay with the 20-period moving average, you can see that it did, right, caught up with the price, right, tested a number of times over here, here, and here. So at this point, when you see that 20 MA is, starting to support the price up into resistance, you can then start to place a buy stop order above resistance. So in this case, you can either reference this high or this high over here with a buy stop order. And in this case, what happened is that the price pretty much exploded higher, right, and went nicely in your favor. So basically, this is the key thing, right, that you want to look for when you're trading breakouts, basically breakouts with a build up. So a quick recap. Right, number one, the price is in a range. It forms a build-up at resistance. The 20-period moving average catches up to the low of the build-up, and you can enter when the price breaks above resistance. So vice versa, right, for trades, right, in the opposite direction, basically, or rather, selling, right, a breakdown. So the rules will just be the opposite of it. So a quick recap to what you've just learned. To avoid the false breakout, number one, you look for the price to be in a range. Number two, you want it to form a build-up at resistance, right? This is basically a tight consolidation, right, at resistance. That's what you're looking for. Number three, you want a 20-period moving average to catch up, right, to the low of the build up. So let's say price is in a range, consolidate. You're looking for the 20 MA, right, to catch up to the low of this build up over here. And when that happens, you can simply, look to enter as the price breaks above resistance. So at this point, right, you have learned, right, how you can avoid a false breakout. in the next section, right, I want to share with you how you can actually predict, right, market turning points, right, ahead of time. Okay, now have a look at this chart and let me ask you, do you think you are able to predict, right, that the pullback for this market is about to end over here, 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 and possibly over here? Do you think you can actually predict, right, where this pullback would end on this chart? For most of you watching this, you will think, nah, Rainer, that's not possible. I have no idea, where the pullback will end. And I get it, right? That was, pretty much how I felt, in my early years of trading. But what if I tell you that, yes, it can actually be predicted? Of course, not with 100% accuracy, but more often than not. And the trick here is to use a moving average that the market respects. So in this case, you see if you overlay with the 50-period moving average, notice, right, how nicely the price bounced off the 50 MA over here, 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 and possibly over here. Now, at this point, you might be wondering, Rainer, this is a cherry-picked chart, right? When I overlay with a 50-period moving average, the price just sliced through it like butter and, I get stopped out. I get it, right? So this is why the key thing, right, is that when you use a moving average in a trending market, the moving average that you're using, right, must first be respected by the market. So how do you know whether the market respects it? So this is a rule to follow, a guideline that I use, is that the price bounces off a moving average at least twice, minimum 2 times. So for example, if the market is trending up higher, pulls back, goes up higher, pulls back, goes up higher, pulls back, and you overlay with the 50-period moving average or whichever moving average you prefer. I usually go with the 50-period moving average because I like to trade trends, right, which are usually 45-degree angle. And it has to bounce off at least twice. So bounce off once, twice, and then when it comes back here for a third time, right, I know that there is a possibility the market could bounce off the moving average again. So this is what I look for. I look for a minimum of 2 tests, a minimum, right, that the market has, bounced off at least twice. And when there's at least 2 bounce, then, I can look for buying opportunities on the next retest. So let me share with you a couple of examples so you know how this works. So if you look back again, this is the chart of a BGFV. Previously, you saw this one, and over here it might seem very foreign. How I know when the market is going to bounce, and in this case, I overlay with the 50-period moving average. You see that we have 1 bounce over here, second one over here. Then I know subsequently, right, the third one here, here, here. These are all potential, right, buying opportunities, right, where I can look to get on board this trade. So how about have a look at another example? Let me just get rid of this first. Same one over here, dollar against the Canadian dollar. You can see that at this point, right, this market might seem random. How do I know when this market is going to reverse here, here, here? Well, you have no idea. But if you use a market, right, or rather a moving average that the market respects, and in this case, the 50 MA again, you can see that, not too bad, right? You can see that the market, tested once over here, twice, and then the third time here could be a potential area where you can look for selling opportunities. And over here, pretty much the price broke through the moving average, and you would probably have gotten stopped out. So at this point, right, is there a way to actually avoid, you getting stopped out over here as the price, blast through, moving average? And the answer is yes, there is a technique that you can use, right, which I want to explain right now. Now, the next important lesson to share with you is that you don't want to use moving average in isolation, because as you've seen what happened, right, if you just blindly buy when the price is at moving average or blindly sell when the price is at a moving average, you could just get stopped out quickly because the market could just slice through it like hot knife through butter. So what you don't want to do is just because you see the market respecting a moving average like this, okay, let's say it's respecting this moving average, tested once, twice, and then come back a third time, you don't want to just blindly buy over here, right, because the price could just collapse lower. So what you want to do instead is to look for a valid entry trigger to tell you that, hey, the buyers are stepping in and about to push the price higher. Only then, right, do you look to enter a trade. So what you want to do is to look for an entry trigger to help you time your entry. An entry trigger can come in many forms. For example, it can come in the form of a reversal candlestick patterns like the hammer, the bullish engulfing pattern, or for bearish candlestick patterns could be things like shooting star or even the bearish engulfing pattern. So in essence, right, what you're looking for instead is for the market first to be trending, okay? And then when you overlay with the moving average, it's respecting this moving average over here, tested once, twice, and then it came back here a third time. Good. Let's say it comes back here a fourth time. Okay. You want to look for a entry trigger, could be a hammer like this, right, to tell you that the buyers are stepping in, after the price has started to reverse up higher. From then you look to enter on the next candle, right, with the expectations that the market could possibly head up higher. So in other words, you're kind of like looking for a confirmation that, hey, buyers are stepping in, they're about to take the price higher, let me get on board right now. So you're waiting for the turn to occur right? Instead of trying to predict, right, that the market will turn over there, we're actually waiting for that small little bounce to occur, then we enter the trade. So let me share with you a few examples, right, of how this looks like. So this first one over here is the chart of SBLK. So recap to what you've learned, right? We are using the moving average, right, to help us, identify or predict, right, where the market could turn. So we are looking for two bounce first, right? We have one possible bounce over here, two, this is a third bounce, and then we got a fourth bounce over here. So at this point, okay, you can see that we had a valid entry trigger in the form of a bullish candle close. Notice how the price, right, closed near the highs of the day. This tells you that the buyers are stepping in and the market could possibly reverse higher. So you can see that the turn has occurred over here. It has, kind of like starting to reverse up higher. So that's where you want to enter the trade. So in this case, you can just simply, look to buy on the next candle open, which is probably somewhere near the opening price on this candle here. So this one example. Another example you can see over here, CZR, same concept. So if you look at this over here, market has tested the 50 period moving average here once, twice. So you can see that in this case, right, the market didn't respect the 50 period moving average to the exact thick or to the exact level. We actually sliced through it by a little bit, then we rallied higher. We sliced through it by a little bit and then we rally higher. So this is like the reality of trading. You don't really get exact levels. You have to treat this as an area on your chart, an area of value. Okay. So in this case, the price comes back towards this third attempt. And again, we are not looking to buy just yet. We are looking for a confirmation that the buyers are stepping in, right, before we look to enter our trade. And in this case, we got it in the form of a bullish engulfing pattern. Notice how this body of this candle has engulfed and covered the body of the previous candle, closing near the highs of the day. So in essence, we are actually looking for the turn, right? This turn, the market to kind of like turn higher, right, before we look to enter. So once it has turned, once it has closed bullishly near the highs of the day, we can enter on the next candle open, which is about here. We'll enter at this price over here. Okay, so this is pretty much an example of how this looks like. Okay, so at this point, right, you have learned, right, not to use moving average in isolation, and we have, so far used moving average and focus a lot about entries. So in the next section, I want to talk about how you can actually use moving average, right, to write massive trends. Now, look at this chart over here and imagine this, right? Imagine that you actually went long, let's say when the price breaks above this high over here, you go long, okay? And the question is, how do you actually get on board and write this huge, right, massive trend? Now, for most traders, right, I can assure you, they will likely get stopped out, right, on this pullback over here, right? Most of them, when the pullback occurs, the market is going to reverse, time to sell, exit. And the next thing you know, the market just boom, right, continue higher. So how do you actually objectively, right, write a trend, right, without giving in to your emotions? So this is where we need to have clear mechanical rules to help you in your trading decision. And the trick here is that you need to use a trailing stop loss. Okay, so what is a trailing stop loss? So a trailing stop loss is basically shifting your stop loss progressively in your favor as the market moves in your direction. So a super quick example is, let's say market is now in a range, okay, and then it breaks out higher, right? Let's say your stop loss at this point is over here. Now let's say it pulls back, right? Your stop loss is not going to shift because the market hasn't moved in your favor yet. Then let's say it continues up higher. Now you shift your stop loss higher and let's say maybe up to somewhere here. Then it pulls back, you're not going to shift your stop loss because the market has, not moved back further in your intended direction. And now let's say it breaks out higher back into your intended direction. Now you shift up your stop loss even higher to somewhere here. So this is what we mean by having a trailing stop loss. We are trailing your stop loss up higher as the market progressively moves in your favor. Now there's one simple tool that you can use, and it's none other than the moving average, right? Since this entire video is dedicated to it. And what you can do is you can exit your position only if the price closes below the 50 period moving average. So let me give you an example or two examples. So over here, you can see this is the same chart. And let's say again, you bought the breakout over here for whatsoever reason, not important. And then you overlay with this blue line, which is the 50 period moving average. Okay, pardon my handwriting. So what you'll do is that you will hold this position until the price has closed below the 50 period moving average. So you can see that yes, we got a pullback over here. But ask yourself, did the price close below this blue line over here? Well, it did not close below it. It touches the 50 period moving average, but it didn't close below it. So you'll remain holding that position that you had, right? So you can see that the close only occurred on this candle here where the price break and close below the blue line, the 50-period moving average. And this is how, right, you can have the chance, right, to ride massive trends like this, right, from this entry point all the way up to this exit over here. So another example, this one is the stock market. Again, let's say for whatever reason you bought maybe on the pullback over here. How do you actually, ride this trend up higher? Again, you can use the 50-period moving average, which is this blue line over here, and you only exit if the price breaks and closes below the 50-period moving average, like this, like what I'm drawing over here. Until it do this, right, only then do you exit your position. If not, you hold on to that long position of yours. Does it make sense? Now, if you're enjoying this video so far, smash the thumbs up button. If not, then hit subscribe. So let's move on and do a quick recap, shall we? So number one, right, you've learned how to avoid false breakout. And the way to do it is by trading breakouts with a build-up. So to do a quick recap, market is in a range like this, comes back to the highs of resistance, and then it starts to form a build-up. You then overlay with the 20-period moving average and see, right, that the 20-period moving average is kind of like supporting the price higher into resistance. When the 20-period moving average has touched the low of the build-up, this is where you can say that, hey, the market has stored enough potential energy and it could possibly break out higher. Okay, so then you can look to buy, right, as the price breaks out of resistance. So the second secret I shared with you is to how to actually predict market turning points in a trending market. And the way to do it is that you want to identify the moving average that's being respected by the market. And to do it, we are actually looking for at least two tests, right? Two bounds of the moving average, right? To identify, the area of value. So in this case, I use the 50-period moving average in this example. So now I want to clarify is that there is nothing magical about the 50-period moving average. The reason why I go with it is because personally, I like to trade this type of trends. This type of trends, right, which respects the 50-period moving average, are usually about 45 degree in angle. So if this is 90 degree, this type of trends are usually something like this, about 45 degree in angle. So I like to trade this type of trends because it's clear, it's obvious, and it gives me enough time, right, to time my pullback entry. Of course, if you want something stronger, like a stronger trend, you can go with like a 20-period moving average. You want something slower, you can go with a 100-period moving average. But the key idea here is to let you know that there is nothing magical about a 50-period moving average. I just use it because it suits me best. And then the third secret I shared with you is not to use moving average in isolation, because or rather any other indicator. You don't want to use it in isolation, but rather you want to combine it with other tools and techniques, right, to help you, time your entry. So in this case, I shared with you, right, how we can combine, right, candlestick patterns with moving average. So in this case, we had a couple of bounds, 1, 2, and then on the third attempt, we are looking for a bullish reversal candlestick pattern. It could be in the form of a hammer, right, to tell us that the buyers are stepping in. And then, right, once the market has, start to turn up higher, then we look to enter on the next candle open, right? So this is what I mean by, don't use moving average in isolation. Don't buy just because the price is at the 50-period moving average, but rather use other tools, other confluence factors, right, to tell you, right, to help you time your entry. And then finally, I shared with you a technique on how you can actually, trail your stop loss and ride massive trends. Again, I went with the 50-period moving average, and again, there's nothing magical about this. So for the 50-period moving average, it allows you to ride, I would say, more towards the medium-term trend. If you want to ride, shorter-term trend, you can go with the 20-period moving average. If you want to go with a longer-term trend, you can go with even, 100 or even the 200-period moving average. So hopefully by now you understand that what I'm sharing with you is that the concepts is what matter. Don't focus too much on the exact parameter like the 50 MA and whatnot, because that is really, not how you understand, right, and get better at trading. Okay, now if you've enjoyed this training so far and you want to learn more trading strategies and techniques, right, then you can actually go down to this website here, priceactiontradingsecrets.com, and get a copy of this book called Price Action Trading Secrets. The website is over here, priceactiontradingsecrets.com. So in this book, right, you will learn, right, professional price action trading strategies and techniques, right, to help you profit in bull and bear markets. We cover things like, support resistance, how to draw them, how to tell when support resistance will break. We dive deeper into candlestick patterns. You'll learn reversal trading strategies, breakout trading strategies. You'll learn proper risk management so you never blow up another trading account, and much more. And when you get a copy of this book today, you will also, get a few exclusive bonuses. Bonus number one is the PDF version of Price Action Trading Secrets. So while waiting for that physical book to reach you, which is about 3 to 4 weeks, depending on where you are in the world, you can start reading, right, this PDF version of this book immediately. Bonus number two, you get this position sizing calculator, so you never blow up another trading account. And finally, you get bonus number 3, which is a part-time trading secrets webinar where you'll learn how to become a consistently profitable trader, even if you have a full-time job. So if you're interested to get this book over here, okay, just scroll down to the bottom of this page, put in your details, and we'll ship the book as soon as possible to you. So with that said, right, I'll put the link somewhere below this video so you can get your hands on it. With that said, I wish you good luck, good trading. I'll talk to you soon.